Welcome back to the Deep Dive. You've given us a really fascinating set of sources today, detailing some pretty fundamental shifts in the digital asset space, things that maybe get overlooked.
Yeah, definitely.
We're not just talking about the day-to-day price swings here. We're looking at big strategic moves, corporations, the Fed, even global capital flows.
That's right.
So our mission today really is to cut through that noise. We want to get a clear picture of how everything's kind of synchronizing. How corporate strategy, regulatory shifts, and market rotation are all lining up and solidifying crypto, especially Bitcoin, stablecoins as, well, potentially foundational parts of the financial system. So yeah, let's unpack this. It feels like a big moment.
It really does. And what's so interesting looking at these sources is how it's happening on like 3 different levels at once, but they all reinforce each other.
Cool.
You've got major corporate activity, M&A stuff. Then you've got these pretty clear signals from regulators. And finally, just a massive shift in where big money is going.
Institutional gravity, you called it.
Exactly. It's not just incremental growth anymore. It feels like something more fundamental is taking hold.
Okay, let's start with that corporate gravity then, because some of these numbers are just, wow. SpaceX, for instance.
Yeah.
The source material shows they moved, what, about $268.5 million in Bitcoin, nearly 2,500 BTC. That's their biggest transaction in years, apparently.
It's a huge move, yeah. And significantly, it's the first big transfer we've seen from them since July. And you have to remember, they're still sitting on a lot of Bitcoin.
How much is it now?
The current holding is around 11,509 BTC. That's valued at roughly $1.24 billion today. So they're still a major institutional player, even if they're quiet about it.
And the history matters here, right?
Yeah.
Because they weren't always holding steady. They sold off a lot, didn't they? Back in 2022.
That's right. Mid-2022, after the whole Terra Luna chaos, they cut their holdings by something like 70%. So seeing them make a big move now when there isn't obvious market panic
suggests it's something different, not defensive.
Exactly. This feels more like optimization. Strategic. The purpose wasn't disclosed, obviously, but one analyst pointed out it could be wallet reorganization, maybe even interacting with Coinbase Prime.
Coinbase Prime.
Which is their institutional arm. And that kind of links nicely to the next big corporate story.
Coinbase.
Yeah.
Right. They seem to be buying up everything in sight. This latest deal is Echo.
Yeah, Echo. The on-chain investment platform founded by Jordan Fish, Cobie.
Ah, Cobie. Very influential figure.
Yeah.
And the price tag?
$375 million. Mix of stock and cash. And it's not an isolated thing. This is their 8th acquisition this year. They also bought Deribit, Liquify.
So they're building something aggressively.
Definitely. It looks like a clear strategy. They're not waiting around. They're buying the tools, the talent, the infrastructure needed to handle serious institutional money down the line.
Okay, but there's this other detail in the source about the Echo deal. It's staying standalone for now, integrating its Sonar product later. But the NFT thing.
Yeah. That's fascinating, isn't it?
Brian Armstrong, Coinbase CEO, spent $25 million on an NFT just to revive the Up Only podcast that Cobie co-hosted. That seems unusual.
It does, but maybe it's the real aha moment here. Why pay almost $400 million for the tech platform and then another $25 million just for a podcast?
Influence. Trust.
I think so. It suggests they know that institutional business and maybe broader adoption isn't just about code. It's about culture, attention, thought leadership. They're buying the whole package, the tech and the microphone.
Huh. So connecting the dots. SpaceX might be using Coinbase Prime for a huge reorganization.
Potentially.
Which shows exactly why Coinbase is spending hundreds of millions to buy platforms like Echo and, well, the influence that comes with people like Cobie.
Precisely. They're building that full-service, regulated layer that big corporations need if they're going to get serious about this space. It's a very strategic build-out.
Okay. So the corporate structure is getting serious. But what about the regulators? Because that's often been the big roadblock, hasn't it?
Yeah. It has. But that seems to be shifting too, and maybe quite dramatically. Let's talk about the Federal Reserve.
Right. The statements from Governor Christopher Waller. He's a Trump appointee, considered pretty mainstream, right?
Very respected, yes. And what he said at the Fed's Payments Innovation Conference was, well, remarkable. The tone shift from the Fed over the last few years is just night and day.
What did he actually say?
He basically signaled a new era. He said, and this is a quote, that distributed ledgers and crypto are increasingly being woven into the fabric of the payment and financial systems. He even called it a new era for the Federal Reserve in payments.
Wow. Woven into the fabric. That's not cautious language.
Not at all. And he even acknowledged how fast it's happened. He mentioned that even talking about DeFi, decentralized finance, in the context of future U.S. payments would have been unimaginable a few years ago.
So recognition that the train has left the station, maybe?
It feels like it, more than just tacit approval. It's like the central bank is saying, okay, this technology is here to stay. We need to figure out how to work with it.
But is it just talk? Or are they proposing actual steps?
That's the key question. And Waller addressed it directly. He proposed something specific, exploring the creation of specialized skinny master accounts.
Okay, skinny master accounts. We need to unpack that. What does that actually mean for, say, a crypto company?
It could be huge. A master account gives an institution direct access to the Fed's settlement system, the core plumbing of the financial system. Right now, most crypto firms, fintechs too, have to go through a traditional bank, a correspondent bank.
Which adds friction cost.
Exactly. Time, cost, regulatory hurdles. These skinny accounts could potentially let crypto payment firms bypass those traditional banks and connect directly to the Fed for settlement.
So building a direct on-ramp for crypto into the central banking system?
Yeah.
Less friction.
That's the idea. It's not just being welcoming, it's potentially re-engineering the plumbing to accommodate them, like building a new freeway ramp, as you put it earlier.
And this comes after they withdrew guidance that discouraged banks from getting involved, right?
Yes, that's critical context. First, they stopped actively discouraging banks. Now they're talking about actively designing ways for crypto firms to plug in. The brakes are off, and they're looking at the accelerator.
Okay, so the corporations are building, the regulators are opening doors. How is this actually affecting where money is flowing? Is capital responded?
It looks like it. Which takes us to that third piece, the market dynamics. And specifically, this fascinating interplay between gold and Bitcoin.
The rotation.
Exactly. We saw a really sharp, aggressive move. Spot gold prices dropped over 5.3% in a single day, fell down to around $4,125.
And that was right after hitting an all-time high, wasn't it?
Just after hitting $4,260. So it was on track for its biggest single-day fall in over 5 years, a major reversal.
And the thinking is that money came out of gold and went where?
The consensus seems to be straight into Bitcoin. While gold was tanking, Bitcoin climbed back up toward $113,800 after seeing some selling pressure earlier that day.
So Bitcoin acting as a destination for that capital flight from gold.
It seems that way. Demonstrating strength, absorbing selling, and then rallying as gold fell. Joe Consorti over at Horizon called it the early stages of an aggressive catch-up trade.
A catch-up trade?
Yeah.
Implying Bitcoin has ground to make up relative to gold, maybe.
Or that capital is finally recognizing Bitcoin's potential role, perhaps accelerated by these institutional and regulatory shifts. And the potential leverage is mind-boggling. Bitwise put out research suggesting even a small rotation.
How small?
Just a 2% shift of capital out of the global gold market into Bitcoin. That alone, they argue, could potentially push Bitcoin's price above $161,000.
Wow. 2%. That shows the sheer scale difference, doesn't it? The amount of capital potentially eyeing Bitcoin now.
It really does. It's like people are looking at gold as this giant, slow-moving savings account and deciding to drain some of it into what they see as a faster, perhaps higher potential stream, which is Bitcoin.
And that decision is probably easier to make when you see the Fed talking about integration and Coinbase building institutional tools.
Absolutely. It gives large investors the confidence, the perceived safety net, to finally make that allocation shift. It all ties together.
But it's not just about institutions on Wall Street, is it? There's a whole other side to adoption happening globally.
Definitely. We need to talk about the sort of silent giant here, stablecoins, and specifically Tether.
Right. The scale is just immense now.
It really is. Total supply for Tether's USDT is getting close to $182 billion. That's a record. I mean, think about that number. A single digital token not issued by a bank.
Bigger than the economy of many countries.
Exactly. That points to massive real-world use, not just speculation on exchanges. It's being used for actual payments, settlement, value transfer.
And the user numbers.
Also staggering. Paolo Arduino, Tether's CEO, announced they now have over 500 million users globally. 500 million people.
500 million. How does that compare to, say, traditional finance adoption?
It's incredibly fast. Traditional banks, payment networks, it took them decades, maybe a century, to reach that kind of user base. Tether's done it in less than 10 years with a decentralized, non-bank digital currency.
Arduino had a pretty strong claim about that, didn't he?
He did. He called it likely the biggest financial inclusion achievement in history. Which is a bold statement, but when you think about access for unbanked or underbanked populations, especially in places with unstable
It
currencies.
provides a real utility
Yeah,
beyond just investment.
absolutely. And I liked his framing of it. He talked about programmable money being like the ultimate social network
How so?
because it's peer-to-peer and it transports both information and value directly between people. It shifts the view from just currency to like a fundamental communication and value layer, kind of like the early internet, but for money.
Okay, let's try and tie all these threads together then. We've got these corporate giants, SpaceX reorganizing huge sums, Coinbase spending vast amounts on infrastructure and talent.
Building the institutional rails.
Then you have the regulators, the Fed specifically, moving from discouragement to actively designing integration pathways, like these skinny master accounts.
Opening the official doors, essentially.
And then the market itself, capital flowing decisively out of traditional safe havens like gold and into Bitcoin, with analysis showing even small shifts could have huge price impacts.
The money is voting with its feet.
And all while this bottom-up adoption, driven by stablecoins like Tether, reaches 500 million users globally, showing massive real-world utility.
Yeah, top-down and bottom-up pressure converging.
So the main point isn't really any single one of these things, is it? It's the fact that they're all happening now, all at the same time. Corporate, regulatory, market, and user adoption, all pointing in the same direction.
Exactly. It feels like a convergence, an irreversible move towards mainstream integration.
So here's a final thought maybe for you, the listener, to chew on. If the Federal Reserve, the heart of the traditional system, is figuring out how to give crypto firms direct access via these skinny monster accounts,
Top-down integration.
while at the same time a non-bank entity like Tether hits 500 million global users, driving massive bottom-up adoption.
Bottom-up disruption.
What does that twin pressure from the very top and the very bottom actually mean for what we even call a payment system in the future? Where does this collision lead?